podcast with the Investing Education Academy. And today we're going to be talking about the effects of the midterm election and the latest inflationary data. So for any of you all who have questions or, you want to find out something specific, I would suggest putting something into the comments now because this will be a quick one. Leon is suffering from a cold, so we're not going to keep him on, but for so long today. So while I do housekeeping, Leon will tell you why we chose this topic.
Yes. So, and by the way, you may see me take a sip of tea. So just FYI, and I may cough too. Okay, real quick. So two major things this week or over the last week. One, the midterm elections. A lot of people don't realize the effects government actually has, and this loves gridlock. So the market loves when there's divided government. So that's exactly what we have. The Senate is run. The Democrats retain that, and the Republicans won the House, and then Democrats still have the White House. So we have divided government. So what does that mean? It generally means most likely nothing will get done over the next 2 years, because again they're going to be fighting each other the whole time, trying to do investigations, lawsuits, the whole nine. So we'll probably have most likely gridlock for the next 2 years. Reason why business loves that is because anytime bills are passed and things are moved through Congress, it can change the business climate, and it can cause some levels of uncertainty, just depending on what the bill is. So if things kind of stay status quo, nothing really gets passed, and the business climate kind of stays the way it is, business loves that, right? So that's bullish for the market. That's good. Second thing is, which is even more important, is last week, because we haven't been on in 2 weeks. So last week, the CPI report came out. Remember, the CPI report is the Consumer
Price Index.
Yes, Consumer Price Index. Thank you. Excuse me. Hey, can't say we don't show up.
Always. We've shown up in the worst, but go ahead.
Right. Consumer Price Index came out last week. It was expected. So the CPI measures consumer inflation, right? Stuff we pay for everything, gas, food, clothes, all that. It was expected to be in the low 8%. It shocked the world and came out at 7.7%. So if anybody's watched the market last week, there was one, I can't remember, I think it was Wednesday. The market shot up like it was out of a cannon when that report came out. Because what does that mean? That means that Jerome Powell, Federal Reserve's whole thing is they need to slow down inflation, and we hadn't seen really any all the CPI reports up to this point had been in the 9s and 8s and kind of just dancing around there. This is the first time it dropped into the 7s, so that was huge. The market loved that. It took off, and then this week, more good news. The PPI, which is the Producer Price Index, which in some ways, is even more important because the Producer Price Index reflects the prices of wholesale prices. The reason why that's important, and it can actually be a leading indicator into consumer inflation, is because that's the prices that stores pay for wholesale goods, right? So if wholesale goods are rising in price, they're going to pass it on to us in retail prices, and that's going to cause inflation. Well, PPI came out this week. It was expected to go up by 0.4%. It only went up by 0.2%. Now you might be saying, well, it still went up. Yes, that's true. It did still go up, but it went up. It dropped. Well, it was below expectations by 50%. That's a huge drop, right? So that's showing that inflation and what the Fed are doing is actually working. These higher interest rates are crushing demand, which is in turn slowing inflation. Now, does that mean that the next report won't be high or low? We have no idea, right? The next report could come out in the 8% again, and the market will probably go down. But this is the first time we've seen meaningful. That's what Jerome Powell said. He wants to see meaningful reduction in inflation. CPI and the PPI both showed that. So great news for inflation. And again, also the we have divided governments after the midterms, which means that a lot most likely won't get done. So and the last point is that typically after midterms, I believe the stat is I should look it up. I forgot. I was thinking about it earlier, but typically the year after midterms, the market is up, I believe, 25% the following year. Now, typically, though, we don't have inflation at a 40-year high, and the Fed raising interest rates. So we may not see that next year, but just know that typically after midterm elections, the market is meaningfully higher the next year. So, something to think about. It's another data point. Not saying it'll happen. Not saying it won't happen. It's just something to think about. So 3 main points. Gridlock in Congress is great for the market. A lot probably won't get done. We're now seeing meaningful deceleration in inflation, which is great. And then next year, well, the year after midterms, the market is up, I believe, on average 25% the following year. And we're going into the quote unquote Santa Claus rally, which typically happens from December 25th through the end of the year. So a lot of bullish signs right now. Does not mean that the market has to go higher. It just means that there are a lot of tailwinds behind us right now. So we'll see what happens. I'm going to stop talking now because I'm suffering.
All right. So for everybody who's watching, you're thinking like, what does this mean for my money? This is still an environment where you don't want to, be purchasing speculative investments. I would stay away from anybody who has gotten excited about the whole what's
that?
When you buy the fund and it then buys another stock. I just can't think of the name right now.
By the fund?
Well, not a fund, but it's you buy into an investment, then it buys another. It switches with a stock for the ticker symbol.
You got me.
No, you know it. Anyway, it's like swaps. Swaps isn't the name. This is gonna kill me. You know the name I'm thinking, but anyway.
Well, okay. Without a name, can you explain kind of what you mean?
Yeah. So I buy into. This is how. Oh my gosh, everything's going blank.
And I'm the one who's sick.
You're the one who's sick. What is the DraftKings? This is
say again.
This is how DraftKings came to market.
Oh, SPAC?
SPACs. I said swap. I was close.
Yeah.
So
SPAC. Yeah. Okay.
So I heard some people recently talking about special interest, special acquisition companies, right? And special acquisition companies are something that you really should stay away from in this market. That is my suggestion. Somebody in our community was recently talking about it, so I'm throwing this out. In this environment, it's still a very sensitive pricing environment for new companies. Money costs a lot more than what it normally costs, which means that their profit margins have to go up. Many of these companies, especially new, are working in a negative just from the first couple of years. They're working in a negative, so that means that the debt they acquire will be deeper. So again, speculative investments. If you're also, this is somebody, and Leon, I told you about this. One of our members was talking about day trading. Mm-hmm. Not saying it doesn't work for people. Generally, you will get burned day trading. Generally, the average person will get burned day trading. This is not the environment for day trading. Also, going into the year before election year, around September to December, you're going to start seeing a lot of volatility in the market. Now, granted, this is an unprecedented environment in which we're in, and you're talking about semiconductor shortage, supply chain issues, war. Then you have unstable government, and more than likely, you're going to start seeing gas prices here going up also. All these things start to cost more for trucks to deliver items. And if it costs more for trucks to deliver items and the goods costs go down, that's balance it out some. So you're going to see a lot of people leaving the market, going to real estate. All of these things mean that the market is going to be somewhat unstable. And what should be said amongst all of this is that's not necessarily a bad thing. The market for 2020 to really 2021, it was a spike in the market that just wasn't normal. And the environment we were in was one where people were staying home. Were COVID, we were on the lockdown. So many people who never were investors just started investing. Some of you all started investing with Investing Education Academy. If you did, the only difference between you all and the general population is you had Leon and I telling you, this is not normal. Do not get used to it. We will see some type of stabilization and normalcy come back to the market, and that's where we're headed. So it's not a bad thing. Even with these interest rates, people were used to money being essentially free. We're just getting back to normal. In U.S. history, money normally is at least 4% or more in cost. Money was almost like zero to borrow because inflation was so low. So all these things that are happening in the market for you all that came in 2020, let this be our PSA. This is not a situation where you should panic and think, oh my gosh, the sky is falling. This is a return to normalcy in the marketplace. So just wanted to put that out there for you all who are new investors. And we know some of you all watching us are new and you don't know how to play the market. But right now, to find quality stocks that are at I will say on sale, and you have a 5-year window or more, this is an absolute excellent time to be an investor. Especially for those of you all, especially, I'm gonna say it 4 more times, especially for those of you all who have children that you have not set up brokerage accounts for your children. This is an opportune time to set up those accounts for your kids. If you need help figuring out how to do it, you can visit us at IEAnow.com. Well, we will be happy to talk to you about it. But for those parents out there who do not have an investment account for your children, this is an opportune time to do it. If you want to know how to do it, get in touch with us. For anybody who's been playing on the sideline and you're thinking, oh, I knew I shouldn't have got in. This market wasn't normal, but right now we're not going to see the rubber band snapback effect that some people are hoping for. It's going to be a slow return to normalcy, and it's going to be a slow climb back up to the highs that you've seen before, like 2020, like early 2021, late 2020. And it's going to be a very slow crawl to that. So with that being said, we owe you.
So we'll make one last point is that from 2000 and the credit crisis was 0809.
Oh,
so
yeah.
2010 to 2000. Let's say 2010 to 2021. The market on average returned 16% per year. So let's say for that 12 years, 16%. Now remember, Brent and I have always said from jump, since the beginning of time, like 300 years ago, or I don't know, 200, whatever it is, 200 years ago. Yeah, 200. The market averaged 10% per year, right? So what does that mean? That shows that 10-year, that 12-year period from 2010 to 2022 was an anomalous year, was an anomaly. And what happened during that time? Interest rates were at effectively zero, right? So money was free. People took all types of gambles, took out loans, margin, whatever you want to have, you did crypto. Like I mean, the risk taking was off the charts. Now we're going back to rates. So right before I bought my house, 2006, my interest rate was 6.875 for my interest rate. Now at the time I was like, holy hell, this is the worst thing ever. Like I'm paying all this freaking money for my loan. But from I don't know, from like the 90s and the 2000s, rates were typically anywhere from 5 to 7-ish%. So that was normal, right? So pre credit crisis 2008-09, we're now getting back to rates what they were back then, which is normal. Rates typically, like Brent said, are typically in the range of like 4 to 5%. So what's going to happen most likely is the stock market is going to go from returning 16% on average over the last 20 some odd years back to that 10%. So as Brent was saying, we're not going to probably most likely not going to see that snap back to the highs. We will see, slow, moderate growth once everything plays out. But we got to get away from this notion that 2020, 2021 was anything real. And we got to get away from the notion that 2010 to even 2020 was anything real. That was an anomalous period too, because again, rates were at zero, and that's just never really happened much in history. So just be aware that we are normalizing. Returns are going to be a lot. Returns are most likely going to be slower, but we're going to probably return to the normalcy of 10% per year, and then to be like 12% when you factor in dividends. Yep. So just FYI on that.
And we owe you all 2 things. And for those of you all who are not IA members, when we did our last hot seat, we found a stock that was in this market returned 75% from January to now,
and paid 7.55% dividend.
So that's effectively like an 80% rate of return.
Mm-hmm.
And so, if you think they're not out there, they are. And if you know how to do the research and find these things, and if you're IA member, you would have saw it. But for those of you all who are not members yet, please consider it, because that was something that I didn't even know about, and I had to add to my portfolio.
And it wasn't even one. We found multiple that were up this year, up over
30%, up to over 30.
Oh yeah, well yeah, we had more. Let's say 30% or higher, and we're paying dividends anywhere from
3. I say 3 because one was
3 to 8%. Yeah, the highest one was 8%. Yeah. And we always said before is that for Brent and I, anything above like 6-7%, you're kind of getting to that danger zone. However, as long as like we did, as long as you do your research and realize as long as that dividend is coming out of profits, it's fine. The problem is when that dividend is being paid out of a loan. That's when there's a problem. But the companies that we found, as Brent said, the hot seat last week or 2 weeks ago, were all paid out of profits. And I believe Brent looked it up actually live on the hot seat. So anyway, any IA members, community members, if you haven't seen it, check out the most recent hot seat is posted in the membership community.
Yeah. And with that being said, we are going to leave you all, but we will be putting our 2 stock picks into the platform. So if you go to IEAmembers.com, log in, you can go to the section that lists all of our stock picks since 2020. And, if you have questions, again, post your questions. And other than that, we thank you all for continuing to be with us. We are still receiving about 5,000 to 6,000 unique downloads per month for our podcast. So that's pretty awesome. And we might be looking at going into some real estate deals that will be showing you all the process along the way. With that being said, have a great day, everybody. Oh, wait.